The Bank of Canada did exactly what most economists had predicted. They held the overnight rate at 2.25%. And on the surface, it may appear boring. No hike, no cut, no drama. But this wasn't a nothing happened decision. This decision tells you that the Bank of Canada is stuck between a rock and a hard place. The bind between raising interest rates and stalling the economy, and cutting interest rates and leading to future CPI growth and inflation. Because the Canadian economy is soft, trade is soft, real estate is soft, manufacturing is soft, and the labor market gave us a worse than expected jobs number in February. And yet, the Bank of Canada decided not to cut rates. Why? Because on one hand, while the economy is sputtering and stalling and demand by consumers is weaker, the commodity prices based on geopolitical risks is significantly amplified with the conflict in Iran. And that's the real story here, is the Canadian economy is weak enough that it could justify the Bank of Canada cutting rates. But it's also fragile enough that any increase in interest rates could lead to a weaker overall economy. It's like being stuck in the middle of the ocean on a boat without a rudder. In the middle of a storm, you don't know which way the boat's going to go next. And from an Austrian economics perspective, this is predictable. It's what happens after decades of monetary distortion. So let's start with a few obvious points. Canada's latest labor data is very ugly. As of February, the economy posted a loss of 83,900 jobs, when generally most economists were expecting job gains. This brought the overall unemployment rate to 6.7%. This is a clear signal of deterioration, and that the underlying economy isn't as rosy as the headlines or policymakers wish to make it. When looking at the balance of trade, the Canadian economy posted a deficit of over $3.5 billion. These were January's numbers, showing the widest gap in the last several months, and exports fell sharply in autos, aircraft, and metals. This tells you that it's just not a consumer confidence story or a weak real estate market story. Overall, the productive momentum in the Canadian economy is weak. And speaking of real estate, the Canadian economy, it's well documented that it's overly reliant on the real estate market. The Canadian housing market has been very quiet lately, and including major markets such as Toronto and Vancouver, where prices continue to stagnate. Now, why does this matter? Well, because the Canadian economy is built on the illusion of prosperity, and inflation drives up asset prices, and some of those assets are the real estate market. Now, when housing slows, it also slows down for investment, both foreign and domestic. And this hits the Canadian economy right in the kneecaps. It hits them on credit creation, consumer confidence, and the general psychological mood of the economy overall. So under normal circumstances, we would see softer unemployment, softer economy, and softer real estate prices. The market would demand a cut. But that's under normal circumstances, and according to the Bank of Canada, these are not normal circumstances. Now, why is it not normal circumstances? Well, we have a major conflict in the major energy center of the world. Crude oil has jumped well over $100 as this conflict continues. And gold has actually dropped as markets price in a stronger US dollar and a higher rate for longer scenario by the US Federal Reserve. In other words, this is not a risk-off, easy scenario where central bankers can ease into a lower, easier money policy. This is an inflation risk environment layered on to some general economic weakness in the overall economy. And that, of course, is very dangerous. So in other data that the bank considered, Canada's core inflation rate was 1.8% in February, just slightly softer than the 2% expected target range. Now, on paper, that should have spurred the Bank of Canada on to make a cut to the overnight rates. But the bank clearly does not trust that that relief would last if energy prices stay elevated. Higher energy prices overall are great for the Canadian resource sector, But elevated prices overall for too long of a period does end up going into the cost of production. And the Canadian economy would generally overall see a lot more weakness. In the Bank of Canada's statement this morning, they said they were looking through this Iranian conflict. And so they weren't prepared to risk another inflation flare up just to rescue the short-term optics. The reality is this is predictable. When central banks suppress the price of money and decouple it from the real market price, malinvestment is soon to follow. They encourage bad decisions that only look rational under artificial conditions. For example, capital flows into sectors for too much, too long scenarios. Debt loads rise, and asset prices float higher than productivity can justify. Government policies are directed to amplify the belief that consumption, leverage, and housing turnover are signs of real wealth. And of course, if you've been watching this channel for any length of time, you'll know that they are not. They are often the after effects of the cheap cost of credit. And when this reality starts to reassert itself, central banks are forced back into the reality of the corner. The economy is too weak for tight money policy. The currency and the price systems are too vulnerable for easy money policy. And this is where we find Canada now and today's Bank of Canada decision. Now, a factor that Bank of Canada Governor Tiff Macklem is not going to talk to you about, but this channel will, is the underlying Canadian political problem. Canada has become a country where management is confused for productivity. If the economy is underperforming, that triggers another framework of policy, another initiative, another debt finance program, another strategy to guide outcomes from the ivory tower. But investors and entrepreneurs know better. You cannot build durable prosperity with rhetoric. You build it with productive outcomes, the right incentives, the consistent application of the rule of law, and a policy framework that promotes capital formation. When those foundations weaken, the government can still talk confidently. They can still package ambition as competence. They can still speak the language of stewardship and national direction. But the markets, on the other hand, are simply going to ask a simpler question. Is private capital becoming more or less confident? Are businesses expanding because the environment, the economic environment of the country is sound and stable, or are they merely adapting to survive? And the answers to those questions are far more revealing than any marketing campaign or branding done by Ottawa. And right now, those answers are not very flattering. So on a subconscious level, this just exposes the central bank dilemma. It exposes the hollowness of the broader economic story. The story that demonstrates you could administratively engineer resilience while the economy is losing altitude. And of course, we haven't even begun to touch on the issues of the trade negotiation upcoming with the United States and Mexico. So here's the bottom line for investors and business owners. The headline says that the Bank of Canada holds rate at 2.25%, but guess what? That's not the real story. The real story is the reason why they're holding rates. Canada is dealing with a weak economy, weak employment numbers, and a soft real estate market, all while energy prices accelerate and geopolitical risks continue to provide a less clear picture of the future. And we are absolutely in the phase that Austrian economists have warned us about. They would call it the hangover phase from the inflation that we had in the previous 5 years. And it's what author Ronald H. Marks said in his 1974 book, The Dying of Money, that at the beginning part of the inflation, everybody benefits and nobody pays. But in the later part of inflation and that cycle, everybody pays and nobody benefits. The distortions and the malinvestments are still there and have not cleared through the economy. The politicians in this country still want you to believe in the management of prosperity. But the underlying structure and the empirical evidence is demonstrating something else entirely. If you found this video to be helpful understanding the Bank of Canada decision or in your journey of discovery on financial literacy, politics, history, economics, and philosophy, make sure you like, subscribe, and hit that notification bell for upcoming videos.